Can you please try now? Or can somebody else please just share his or her own screen? Please, can somebody else on this place
I can share now. I can share now.
Okay, no problem.
Mm.
So apologies for that. You can continue, ma.
Okay. Please confirm you can see my screen now.
Yes.
Yeah, it's obvious now.
Okay, thank you. So let's continue. So we looked at the cumulative net emoluments that is expected to be filed to the tax authority. We looked at the certificate of deduction of tax. I'm just running through the stuff we have done. We equally look at the death of an employee, the tax implication that involves what the tax authority says when an employee dies. Is he expected to pay tax or not? So if the next of kin of the deceased is receiving any money, and that money, that amount, that emolument should be subjected to tax. That's what the law says. We looked at the remittance of tax deducted, and we established that the tax deducted should be remitted to the tax authority within 10 days of the end of the following month. So the taxes for the month of July are expected to be remitted on or before August 10th. That of August are expected to be remitted on or before September 10th. So 10 days, you have the grace of 10 days to remit your taxes. So we looked at the demand for remittance of tax. If an employee refused, or yes, if an employer did not remit the tax accordingly, the tax authority have the right to deduct to demand for the tax remittance. Where I work, I usually get call from the tax authority, maybe that 10th, sometimes 9th, sometimes 10th, they will call me. But if I have remitted before that day, they will not call me. So they have the right to call to demand for the tax for it to be remitted. We looked at the application of the Act, inspection of records, the duty of a successor in title, notice to render tax, notice of assessment. I think that was where we stopped. So today we want to continue from the allowable and disallowable deduction, that with respect to personal income tax. What are the allowable deductions? After you have generated or you have ascertained the total emolument of an employee, that's the total income of an employee, what can you deduct for the purpose of tax? Those are the allowable expenses. Then disallowable expenses are what should you not deduct for the purpose of tax? Those are the disallowable expenses. There's one thing about disallowable and disallowable expenses. It is a common thing within most of the taxes, most of the different types of tax that you learn in the course of preparing for this exam. So if you know it very well in one of the topic, you can apply it to the other one, except for PPT, for petroleum profit tax. Petroleum profit tax is a special type of tax, so they have their own allowable and disallowable expenses. And I don't think you have that on this syllabus for skills level, and PPT is for professional. So let's pay attention to these allowable and disallowable expenses, because it's something that you can use in other topics also. So what are the allowable expenses? According to Section 20 of the Personal Income Tax Act, as amended in 2004, first of all, a sum payable by way of interest on money borrowed and employed as capital in acquiring the income. So, for example, for a sole proprietor or an individual that ventured into a business, you borrowed money for that business. You went to borrow money from LAPO or all of these microfinance bank for the purpose of that business, and you are using the money for that business. And of course, the people that gave you money will expect you to pay some amount of interest. That money that you are paying, the interest that you are paying, is allowed as an expenses. You can deduct it from your profit and say this is interest expense, and the tax authority will not question it. But that capital must be for the purpose of acquiring that income, because look at it, if there is no capital, the income will not come. And if there is no income, what will you pay the tax on? So that is why it is an allowable expense. Another allowable expense is interest on loan for developing an owner-occupied residential building. So you are using your building for the purpose of the business. You borrowed loan to make that business. So the interest on that loan, you borrow loan to acquire that building or that house. The interest on that loan should be deducted from the profit. That is an allowable expenses. Rent for that period and premiums, the liability for which was incurred during the period, payable in respect of land or building occupied for the purpose of acquiring the income. If you rented an office, for example, or you maybe lease an office, for example, the lease has a special treatment depending on the type of lease. There are some leases that are expensed, while there are some that are not expensed according to this accounting standard. So if you are paying rent for a building and you are using that building for the purpose of generating income, that rent is an expense for generating that profit. So you can deduct the rent as an allowable expense. Also, any expense incurred for repair of premises, plant, machinery, or fixtures employed in acquiring the income, or for the renewal, repair, or alteration of any implement, utensils, or articles so employed. So this is repairs generally, be it the building, be it the machinery or the equipment that you are using. So any expense that you incur in that equipment, in that building, any repair expense that you incur, you can charge it. You are free to charge it as an allowable expenses. But provided that equipment is what you are using for the business, the premises, the office premise that you repair, you are using it for the purpose of the business too. But there are exceptions to all of these. According to IS 16, property, plant, and equipment, there are exceptions. There is an amount you will incur in repairing an equipment, a PPE, for example, that you will not expense. There is an amount that you will not expense, you capitalize it, but that's according to 16. But bringing it that to repair, where you repair the building, you can expense the amount and say, I spend this amount to repair this building, because you need to repair the building for you to be able to use it for the purpose of the business. Remember, all of this had to be in place for the money that they want to charge tax on to come out. So because of that, you are free to expense them as allowable expense. Another type of allowable expense is any provision for bad debt of a specific nature. Provision for bad debt is a disallowable expenses. But if the bad debt provision is made for a specific nature, then it is an allowable expense. Another type of allowable expense is bad debt written off. When I was writing ICANN exam, the first allowable expense I have in my head is bad debt, even if I don't remember any other one. Bad debt. Well, when I just pick my question, okay, bad debt is allowed. when I want to pick the disallowed from it, because most time they will put allowed and disallowed. So you're expected to remove the disallowed from it and leave the allowed in the question. So bad debt written off. Bad debt written off is a debt that you have used different means to recover your money, and it is certain, it is sure that the person or the organization will not pay. For example, the person died. The person that is owing you died. You know that money will not come again because the dead will not come and pay you. So if you can write it off, you can put it as your expenses to reduce your profit. Another type of allowable expenses, contribution to a pension, provident, or other retirement benefit fund, society, or scheme recognized under the Pension Reform Act, Section 20. So we have pension, and pension is an allowable expenses. So if you are paying pension as an individual, you are contributing the recommended percentage, what the pension, what Pencom has said that you should contribute. That amount, you should less it from your profit before paying tax. You should deduct it from your profit before paying tax. Another type of allowable expense is legal expense that are limited. So legal expense is a very broad term. Legal expense can come in different form. So the tax law is telling you the type of legal expense that you should deduct, not just any kind of legal expense. So what are the type of legal expense that should be deducted? One, general legal advisory service. You employ a law firm or a legal counsel to advise you on some legal issues. The interpretation of the law is quite different from how we that are not in law we see it. So you want to get somebody that understands it to explain to you. You want to venture into a business, you want to understand what the law says about that particular type of business. You understand? Or you're already in the business and something happened and you need to get a legal advice for you to be able to know how to act on it, so that you don't act wrongly. So you seek the services of a lawyer or a law firm to advise you. Remember, you are doing it for the purpose of the business, so it is an allowable expenses. Another type of expense is retainership fee. So some companies have their legal advisor as, let me put it in form of consultancy. So the legal advisor is there year in, year out. So at the beginning of the year, for example, there's what you pay them, you pay them as retainership fee. Then if they do any service for you in the course of the year, they cannot charge you for that, but you need to pay them to own them, so that you can even be calling them anytime you want. So you need to pay that retainership fee. So that retainership fee is also an allowable expenses. Another type of another legal expense is renewal of short lease, tenure of less than 50 years, short-term lease. So if you have use a legal expense, a lawyer to make arrangement for lease, and you are renewing it, that expense you are making is an allowable expenses. Any cost of protecting and defending the property of the business is also a legal expenses. Maybe somebody is trespassing to the land that belongs to the company or the building. Somebody is trespassing and the issue was taken to court, or you needed a legal counsel to be able to handle the issue. That's also the money you are paying to that for that effect is also an allowable expenses. So lastly, we have any other expense proved to the revenue to have been incurred wholly, reasonably, exclusively, and necessarily incurred for the purpose of the business. So apart from all of these that have been listed from 1 to 8, if there is any other one that is wholly for the purpose of the business, it is necessary for the business, it is reasonably for the business, and it is exclusively for the business, then it's also an allowable expense. Why did they put this clause here? They have to put it here because businesses, they vary. the activities of each business. There are some companies that what they do is not even here. So, but because they need to do it for the purpose of that business, then they have to, it has to be an allowable expenses. Please confirm you are still with me. Let me see your emoji to know that we are still together. Okay. Okay, thank you. So that's that on the allowable expenses. So you can just use REN to remember this last one. WREN, REN. Wholly, reasonably, exclusively, and necessarily. So any expenses that meet the REN requirement is also an allowable expenses. So in most cases in question, you will see it there. They will state it clear. Even the statements will tell you that this one is an allowable expense. So don't say because it's not part of what is listed, it's not a allowable expense. So you have to read and understand it, understand the clause. Then it will now help you to determine if that is an allowable expense or not. So let's quickly run through the non-allowable expenses. What are the expenses that you want to put in you want to deduct from your profit, and by the time the tax authority sees it, they will add it back. When they see it, they will remove it, they will add it back to your profit, they will add that amount back to your profit, and your profit will increase, so that the money you want to pay for tax will increase also. One, domestic or private expense. Your personal expense. No, ideally, the business is separate from the owner. That's entity concept in accounting. The business is separate from the owner. So you are not expected to use the business money for your personal, your private expenses and still have it in your expenses. You want to use it to deduct your profit. As the business owner, if you want to spend, you're expected to pay yourself. You're expected to pay yourself as a business owner. No, determine how much you can be paid. If you like, carry all the money and be paying yourself. Determine what is reasonable for you to be paid. Then that is what you will spend, not spending from the company's profit. Capital withdrawn from trade, business, profession or vocation, and any expenditure of a capital nature. If you carry out an expense of capital that is capital in nature, it is not an expense. It is not a tax deductible expense. You bought a car that the company is going to use for a long time, more than 1 year, and you expect to remove it from profit. No, that's a capital expense. That's why we have OPEX and CAPEX. OPEX, they are operating expense, while CAPEX, they are capital expenses. So if you make a capital expenditure, you are expected to capitalize that expenses, and you bring it in as an expense in the form of depreciation. So that expense is not for 1 year. So take for example, now you bought a car of 50 million and you only made profit of let's say 55 million, and you bring in that car as an expense, for example, it means that the company will be reporting a very small profit. And mind you, that car that you bought for that 50 million, you are not using it for just that year. You are going to use it for more than 1 year. So the cash should be spread across the lifetime. In the process of spreading it across that lifetime is what the accountant will call depreciation, bring it in as depreciation. Why? For the purpose of tax, it is capital allowance. The tax accountant will use capital allowance to bring it in as an expense, while the financial accountant will bring it in as depreciation. So you cannot bring in a capital expenditure that is going to stay for more than 1 year as an expense for the purpose of tax for a particular year. It is not done. So any capital withdrawn from trade, business, profession, or vocation, and any expenditure of a capital in nature is not allowed. So it is a non-allowable expense. Any loss or expense recovered under an insurance or contract of indemnity. So if you have an insurance, you made a loss, let's say car accident, for example, and the car is under an insurance, there is an insurance indemnity on that car. You should not bring in the expense of bringing that car or repairing that car in, because the insurance already covers it. The insurance contract already covers that. So there's no need bringing it in as a deductible expenses. Rent of rent of or cost of repair to any premises or part of premises not incurred for the purpose of producing the income. Take for example, your rent at home as the owner of the business, your rent at home, or your wife's rent, you bring it in because you are running a business. It is not allowed. The business, that rent is not for the purpose of generating that profit. That rent is not for the purpose of generating that profit. Whether you pay that rent or not, the profit will still be generated. So it is not an allowable expenses. It is disallowed. If you put it in, the tax authority, when they are reviewing your book, they will remove it. They will remove it. Taxes on income or profit levied in Nigeria or elsewhere, except as provided in Section 13 of the Act. Taxes on income or profit levied in Nigeria or elsewhere, except for those that are provided in the Act. Any payment to a pension, provident, savings, or widow and orphans society, funds, or scheme, except as recognized under the Pension Reform Act of 2014. So if you are paying a pension that is not in the pension, is not in line with the Pension Reform Act of 2014, and you are making such payment, it will be disallowed. The all pension that should be paid should be the one that are in line with the 2014 Pension Reform Act. Then the next one is depreciation of any asset. Like I explained, the accountant will use depreciation, while the tax person or the tax consultant will use capital allowance. By the time you do company income tax, you see how capital allowance is computed. So if you have used depreciation, if you have deducted depreciation to arrive at that profit, that depreciation will be added back, but a relief will be given to you in the form of capital allowance. The capital allowance relief will be given to you. So depreciation also is not an allowable expense. You see it in your question, and if you want to reason it as an accountant, normally depreciation is an allowable expenses. But then for the purpose of tax, depreciation is not an allowable expense. The reason why the tax authority does not allow depreciation is because of the multiple methods of computing depreciation. Depreciation has different methods. I think there is a particular method that every company is using, then depreciation will be allowed. But because they have multiple method of computing depreciation, and the company is at liberty to choose the one that they want to use. So it's not a case of this one will use this method, this one will use this method. So different method is confusing. So that's why they disallow it, and they give that capital allowance relief in place of depreciation. Then another disallowable expense is any sum reserved out of profit, except as permitted by the revenue based on Section 20. If you just decide to pull out an amount and say, this one is reserved, it is not allowed. Any expense of any description incurred within or outside Nigeria for the purpose of any management fee, unless prior approval of an agreement give rise to such. Unless there is an approval from the minister. Unless there's an approval from the minister, if you do any expenses that is related to management earning, it is not allowed. Then another disallowed expenses is any expense whatsoever incurred within or outside Nigeria as management fees under any agreement, except entered into, except to the extent as the minister may allow. So any form of management fee that is that you are deducting from your profit. You say this is management fee. It is a disallowable expenses, except it is allowed by the minister. So let's quickly run through the basis of assessment. The basis of assessment used by the relevant tax authority for the determination of personal income tax liability of an individual is actual basis. Actual basis, that's what the personal income tax use. However, it is pertinent to note that in determining the gross income of an individual, income from employment is based on actual year basis, while unearned income are based on preceding year basis. Your earned income is based on actual year basis. For example, your payee, the one you pay on your salary, is actual. Before they even pay you your salary, they have removed it. So January payee, you see it in January payee will be deducted in January. February own will be deducted in February, except for those companies that don't used to pay salary on time. So that makes it actual. Then for the unearned income is remitted or is assessed on the preceding year basis. So let's quickly look at the tax exempt deductions, those deductions that are exempted from tax. So before we continue, please confirm we are still together in this class. Okay, I can see your emojis. Thank you, thank you. Our time is fast spent. It's 39 already. So what are those deductions that are exempted from tax? You don't pay tax on them. You deduct them for the purpose of computing your profit. One, NHFC, National Housing Fund contribution. The National Housing Fund is allowed. You should deduct it from the salary of the employee before computing the tax. However, not every company does this. So, companies' policies vary. Each company have their policy. They don't do everything. So it depends on where you are working. So don't go and say after this class now, why are they not deducting? Why is my company not deducting? Ideally, they are supposed to deduct, but most of these are private companies. It's not everything that they actually do. So the National Housing Fund Act 2004 provide that a Nigeria earning an income of 3,000 and above per month in either the public or private sector of the economy shall contribute 2.5% of his basic monthly salary to the fund. Employers who fail to deduct or remit are liable to pay penalty of 50,000, while self-employed persons are to pay 5,000 or 1 year imprisonment on conviction or both. So if they are not deducting it, the penalty is 50,000. Then if you are the employee, you are self-employed, your penalty is 5,000. Either you pay this or you be convicted, or you can still be convicted and still pay the fine. The employer is to deduct the contribution the employee's salary, monthly salary, and remit it to the Federal Mortgage Bank of Nigeria within 1 month of making the deduction. The Act mandates the Federal Mortgage Bank of Nigeria to collect, manage, and administer the funds. Contributions are made to the funds are tax deductible. This contribution that you are making is tax deductible. So 2.5% of your basic monthly salary is subjected to this housing contribution, national housing contribution. So you should deduct it and remit it to the Federal Mortgage Bank of Nigeria within 1 month. So it has a deadline too, because one thing is to deduct, another thing is to remit it. Pay is 10 days. This one is within 1 month, so it will be calculated from the day that it was deducted. Another tax exempt deduction is the health insurance scheme, NHIS. The National Health Insurance Scheme was set up by the National Health Insurance Act for the purpose of providing health insurance which shall entitled person insured under the scheme and their dependents the benefit of prescribed good quality and cost-effective health services as set out in the Act. So for national national health insurance scheme, NHIS also is a tax deductible expenses. So you can deduct it from your from the employee's salary before computing the tax. The Act provides that an employer shall have a minimum of 10 employees. An employer who has a minimum of 10 employees, so it's not everybody now. So if you have a minimum of 10 employees, together with every person in his employment, pay contribution under this scheme at such rates and in such a manner as determined from time to time by the governing council for that scheme. In the public sector, the employer is expected to pay 3.25%, while the employee pays 1.75%, which translates into 5% of the employee's consolidated salary, just like pension. For pension, the employer pays 10, while the employee pays 8. So in all, is 18% of the consolidated salary. In this case, the employer pays 3.5 and the employee pays 1.75. The total makes up 5%. In the case of private sector and other tiers of government, the employer is expected to pay 10%, while the employee pays 5%, representing 15% of the employee's basic salary. The employer may decide to pay the entire contribution. Sometimes, the employer may also undertake extra contribution for additional coverage to the benefit package. So depending on the package that you are doing, the employer can pay more for it. An employer under the scheme shall cause to be deducted from an employee's wage the negotiated amount of any contribution payable by the employee. The employer's contribution and the employee's contribution in respect of this employee are to be paid into the account of a designated health maintenance organization. Contribution and the scheme are tax deductible. Again, most companies don't do that, but they do HMO. So for the purpose of this is your health insurance. So when they deduct it from your salary, they're expected to, when you are sick or your dependent is sick, you go there and you take treatment, and maybe you pay minimum, or in some cases you are not expected to pay again. But most companies, what they do is HMO. They have HMO that covers their staff. So, but for the purpose of this class and for the purpose of this exam, you're expected to know this NHIS, because you see it in your questions. You see it in your question that the person and the dependent, Mr. This and the dependent, they are subjected to this and this NHIS. So please, let's take note of that. Life assurance premium is another type of tax exempt expenses. All of these that I'm saying now, if you see them, you see them in your question. So you should know that these ones, they are not subject to tax. A deduction of the annual amount of any premium paid by the individual during the year preceding the year of assessment to an insurance company in respect of assurance on his life or the life of spouse, or for a contract for a deferred annuity on his own life or the life of his spouse. So if you have a life assurance arrangement that you are doing and you are making payments, a premium, the employer deducts from the salary of the employee and pays for life assurance for them. And in most cases, the companies are the one paying. The employees, they don't even touch the employee's salary. The company will be the one to pay. So those kind of expenses, those kind of payments, they are tax exempt. They can be deducted for the purpose of tax. Another one is the national pension scheme. This one is very, very common. This one is very common. I think most companies, 80–70% of companies, they do this. This one is the Pension Reform Act is established a uniform contributing pension scheme for payment of retirement benefit of The scheme applies to all employees, both in private and public sector. Both in private and public sector who are in employment in an organization which there are 15 or more employees. So when there are 15 or more employees in an organization, then the organization is expected to remit pension on behalf of the employee. When once the number is up to 15 or more, then they are entitled to pension. The rate of the contributions to the scheme shall be a minimum of 8% of the employer's monthly emolument, which is your monthly emolument here is the basic housing and transport. That was what we call BHT, as contribution for employee in the public and private sector, and 10% of the monthly emolument as employer's contribution. However, contributions are made by employee to the scheme shall be tax deductible. What are the main points here? 8% from the employer, from the employee, 10% from the employer. This is what will be paid to that pension. We already know the use of pension. It's your retirement savings, something that you save for future. So by the time the bones are not strong, that can no longer work, you are that's just the brain behind pension. That's what you will not use till death will come. So why the individual is working, the individual is expected to contribute 8% of the monthly payments, whatever you are earning monthly, your monthly emolument, which is the total of your basic housing and transport allowance. You are expected to, the employer is expected to deduct this and remit it to your PFA. 8% from the employee and 10% from the employer. Notwithstanding the foregoing mode of contribution to the scheme, an employer may agree or elect to bear the full burden of the scheme, provided that in such a case, the employer's contribution shall not be less than 20% of the monthly emolument of the employee. It is pertinent to state that the tax relief is only limited to pension contribution to scheme, provident, and retirement benefits fund that are recognized under the Pension Reform Act of 2014. So the employer can decide to pay all the money and give the employee their complete salary. So if the employer is not deducting pension, you know that what is subjecting to tax will still be high. If your tax, they are not deducting your salary, they are not deducting pension from it. You know, the employer is taking the pension now as an expense, which will reduce the profit. Then is a give and take thing, 50-50. Then the employee too will be paying higher tax, because what was supposed to reduce the tax is no longer reducing the tax. So that is it. So either ways, tax is still being deducted. So that's for pension. So pension is also one of the tax exempt items. Another one is the gratuity. Gratuity is the money paid to employee who is retiring or leaving his employer after several years of service. Gratuity is tax deductible. So that's another type of tax exempt also. So before we continue with the computation of the consolidated relief, please confirm we are still together in this class and we are following. All right. Thank you. Thank you. I can see that. Thank you. I just want us to be on the same page. Can you still see my screen, please?
Yes,
Okay.
yes.
Yes,
Okay.
can see it.
Thank you. Thank you. So let's continue.
No.
Ma, they're asking questions, so.
Just hold on. After the class, after a while, I will take your questions. Let me check.
All right.
Questions. I'll take your questions. I'll take your questions. Computation of consolidated relief allowance. How do we compute the consolidated relief allowance? First of all, we want to look at what is gross emolument. I've explained in course of the other explanation. But this means wages, salary, allowance, including benefits in kind, gratuity, superannum, and other income derived solely by reason of employment. Everything that you are receiving as an employee added together is what is called gross emolument. Whether the is a benefit in kind, we listed benefit in kind when we were looking at taxation of employment income, where we looked at the company paying for your domestic staff. The company is the one that is paying for your rent. The company gives you maybe a car. All of those are benefits in kind. And we also saw the tax treatment of the tax implication of all of that. If the company is the one paying for that, for those things for you, what you are expected to do, or what is expected to be deducted from your salary as an employer. Added together, they are called benefits in kind. So by the time you add the benefits in kind to your salary, the one that is coming in as salary, all of them added together is what we call gross emoluments. Gross income means income from all sources, less non-taxable income on which no further tax is payable, tax exempt item listed in paragraph 2 of the 6th schedule. All allowable business expense and capital allowances. So that's what we call gross income. They are income from all sources after you have removed those income that you are no longer paying tax for. After you have removed them, you have equally removed those tax exempt income, which is what we call the gross income. So how do we calculate the consolidated relief? The consolidated relief allowance is higher of 200,000 or 1% of your gross income plus 20% of gross income. So you compare 200,000 to 1% of your gross income. So it now depends on what your gross income is. If your gross income, for example, is 5 million, so you calculate 1% of that 5 million. You calculate 1% of that 5 million and you compare it to 200,000. Which one is higher? Which one is higher than the one that is higher is what you will pick.
200,000 is higher.
200,000 is higher. Then you add it to 20% of that gross income, which is 20% of that same 5 million. So at all time, you have to calculate and compare. But you can already know, if you, like when I was practicing, I already know the amount that the gross income will be that can be higher than 200,000. So for your speed and accuracy in the exam, you should already know, you should already know that, okay, it's at this level that the 1% will be higher. So at what level can 1% be higher than? What should the salary be? Let me test people now. What should the salary be that 1% can be higher?
Million.
From 120 million. From 20 million.
From 20 million. From 20 million. Okay. From 20 million. So 20 million will still give you 200,000. Right? 1% of 20 million will give you 200,000.
Above 20 million.
So above 20 million. Thank you. So once you see that the gross emolument in your question is above 20 million, then you should know that you are going to calculate your gross, the 1% of gross income. You are no longer picking 200,000 at that point again. But when you see that it is below 20 million, just go straight. Use your 200,000 and go to 20% of the income. Then you are using it to buy time for yourself. You're using it to buy time for yourself, and you move on with your question. Now, this is our tax table that we use to compute. These are tax table that we use to compute our taxes. So at the end of all the deduction, when you have deducted everything and you've equally deducted the consolidated relief, then you will now apply, you compute the tax with the application of the tax table. This tax table will no longer be effective as from January 2026, based on the new tax reform, that tax reform that we had was it last month or last 2 months? Yes, as from January, we will no longer use this tax table. We'll now have a new tax table that will take effect from January. But for now, we are still using this tax table to compute our pay. So for the first 300,000, so after computing everything and you now have the total amount that is going to be subject to tax, you now have to start picking it one after the other. The first 300,000 in that amount is subject to 7% tax. The next 300,000 is subject to 11% tax. The next 500,000 is subject to 15% tax. The next 500,000 again is subject to 90% tax. And the next 1.6 million is subject to 21% tax. And the above 3.2 million is subject to 24% tax. So for somebody that the salary falls within, let's say 600,000, the person will only pay for the first 300,000 and the second 300,000. So this is a progressive tax system. The higher you earn, the higher you pay.
Is it just me or everybody is not hearing at all?
There's no more audio. You can't hear anything again. I think it's
It's
from
like
our
she
hand.
log out. It's
They
like
are
she.
sorry. I'm not. Am I the only one not hearing her? I don't know.
I'm not the only one.
Our network is bad, so
Not
she's trying to log in back.
I think it's network.
Okay.
I think there's network problem. Am I the only one? Hello?
You are not the only one, so probably she's trying to
Hello.
log in again.
I guess she's out of the call.
Yeah, sorry, our network went off, so I just called her. She didn't even know, so she will join back shortly. Oh, thank you so much, sir.
Please, someone should remind me where we stopped. But I didn't know I was talking to myself. First of all, please confirm you can hear me.
Yes, we can hear you now.
Okay. I didn't know my network disconnected and I was just firing down. It was one of our other tutor that called my attention to it. I'm very sorry about that. Please, where did we stop? Where did you stop hearing me so I can
We were
pick
talking
it?
about the tax liability table.
I was talking about what?
The table.
Okay, the tax liability table. Oh,
Yes, the
okay,
tax liability table.
okay, let me just start from there. Let me just start from there again.
You
Okay,
gave
so
with 7 million the 7%.
Okay. So you can mute yourselves now. Let's continue from there.
Those rates.
So I explained that we are going to use this tax table within now and 31st of December 2025. So by the 1st of January, this table is no longer useful. We are now going to use the new one that has been issued based on the new tax reform that we got last month. Was it last month or last 2 months? So that's for that. So, and I explained that after you have computed your gross income, after you have computed your income, then you deducted what you need to deduct. You deducted all you need to deduct according to the law, not just what you wish. Your tax exempt, those income that have already been subjected to tax, you have deducted all of them. Then you will now bring in your tax table and use it to compute your tax. For example, the first 300,000 is subject to 7% tax. The next 300,000 is subject to 11% tax. The next 500,000 is subject to 15% tax. The next 500,000 is subject to 19% tax. You have to take note of them. You are seeing 300, but yet they are different percentage. You see 500, yet they are different percentage. Then you see 1.6 million, which is 21%, and you see 3.2 million, which is another 24%. So it's a progressive tax system where the higher you earn, the higher you pay. The higher you earn, the higher you pay. So for somebody that is the yearly salary after all the deductions and the relief have been deducted, what you have remaining is 600,000. You see that 600,000, you're going to be subjected to 7% for the first 300,000 and 11% for the next 300,000. Unlike somebody that has 10 million, after the deduction, the person still have 10 million remaining. That person will definitely run through the tax table. And you see that the higher it is going, the higher the percentage. So I said for the purpose of the exam, we are going to stick to this format. And I also explained that this format is different from what we use in the practical. In the sense that what we use in companies in real life. So, but for the purpose of exam, we are sticking to this format. Please confirm you can see my screen. This is a bit blurry, but please confirm you can see it. Okay, thank you. So this is the format we are going to use to compute the personal income tax. And when you are practicing also, this is what you will use so that you get used to the format. One thing about this ICANN exam is practice. ICANN needs like time. It needs your time. You have to have that time to dedicate to it. By the time if you dedicate the time for it, you skate through the exam once. Just that most of us are working and we don't really have the time to do it. By the time you practice, you see that most of the questions that are even coming, most of the line items that will come here, line items that you are familiar with, you've seen their treatment, you know how to play, where to place them, and so on. So this is the table, the format we are going to use. So in this format, we first of all pick the earned income. Those income from employment, income from gratuity, income from any trade or other sources. Those are what you put there as your earned income. So you total it and have a total. Then you now bring the unearned income, such as dividends, rental income, interest, royalty. You bring them in at a gross. Remember that before dividend gets to the owner, the company that is paying that dividend would have removed the tax that is on that dividend. So, but for this purpose, you gross it up again. So when you gross it up, When you gross it up, you will get the gross amount. So there's a way you gross it up. I'm going to explain when we are doing the practice. So when you gross it up, it is the gross that you bring into this table. Excuse me. Please give me some seconds, please. All right, let's continue. Please, let's continue. So I was explaining that you add your earned income together and you bring out the sum. You equally add your unearned income together and you bring out the sum. Mind you, not everything here you see in your question. Don't come and say there's interest in the format and there's no interest here. Where is the interest? No. This is a broad format that covers everything. So what you see in your question is what you will use. The most important thing is that you should know where to put it. Know where to put those items that are in your question. Don't go and be looking for things that are not there. Hope that is clear. So this is just a broad format. So after you have added your unearned income, you now have a total income. Then from your total income, you determine those tax exempt, those income that are not taxable, such as those income that tax have been paid on them before. Example again, dividends. You know that the dividend that is coming to you as an individual, if you invest in a company and a company is paying you dividend, before that dividend comes to you as an individual, that dividend had already been subjected to tax. So there is no point for you paying tax on it again because tax has been deducted from it. If you pay taxes, that's multiple. If you pay tax on it, that is multiple taxation. So because of that, you will deduct it from it. So is that a case of you see the dividend, you add the dividend as part of your total income, and you will deduct it again to get your income that is going to be subjected to tax. After that, you now remove your tax exempt item, which are the items that I explained in the course of the class: the National Housing Contribution Fund, the National Pension Fund, the National Health Insurance Scheme, and the Life Assurance. Again, not everything you will see in your question per time. Only use the ones that you see. This is just a format. This is a format, a detailed format. So after you remove your tax exempt item, you now get your gross income. So it is your gross income now that you compute your consolidated relief on. You must get your gross income first before you introduce your consolidated relief. So when you get to
Hello.
gross income.
No more audio.
Is that for me, please?
Yes,
Yes,
we can hear you now.
can hear you now.
Okay, can you hear me now?
Yes.
Okay, let me take that again. So when you have gotten to your gross income, you've determined what your gross income is. You now calculate your consolidated relief. So your consolidated relief is 200,000 or higher of 200,000 or 1% of your gross income. Don't add 1% plus 200. of the two, you are picking the one that is higher, plus 20% of your gross income. So what you have will now be deducted from your gross income to get your chargeable income. So by the time you've gotten your chargeable income, it is your chargeable income that you now, that's where you now introduce your tax table. Whatever you get as your taxable income, that's where your first 300,000 will come in. Your second 300,000 will come in. Next 500 will come in. And the rest following the table. So you must understand that table very well. You must know the table very well for the purpose of the exam. Then computation of income of an employee relating to trade and other source of income. This is the format. The one we did now is for somebody that is receiving salary. You receive salary, then maybe you invested in another company and the company is paying you dividends. So, and maybe your company too is paying you gratuity. That's the first one that we have looked at, where we looked at the end income and the unearned income. So for this one now, if you are trading a sole proprietor, you are the owner of your business.
Sorry, I have a question. I hope I'm not interrupting.
You are actually. Can you please
I'm
just hold on?
sorry.
Maybe after this
Okay.
format, I will just give two opportunity to two persons to ask.
Okay.
Let me just explain this format. So for somebody that is trading, that is doing business, as an individual that is doing trading, doing business, self-employed now, your own type of you want to compute the tax that you want to pay. This is the format that you will use. First of all, you have to determine your net profit. That net profit would have been determined in your account by your accountant. Now, this is the tax consultant or the tax accountant that is working. When you are answering tax question, put yourself as a tax consultant, or you are somebody that the company employed for the purpose of tax. That's what you are doing now. Now, the accountant has finished preparing the books of account, and they have arrived at a net profit. So that's the net profit that you will pick. What they declare as the net profit is what you will pick. Then you now look at the books and say, disallow, and pick out the disallowable expense. They have put a lot of things there to arrive at that net profit. So you look at those lot of things that they put, and you pick out those things that are not expense. They are not allowable expense according to the tax law. So you add them back. You add back all disallowable expenses. We have listed disallowable expenses also. Then you also add back taxable income not reported. Some income that they did not put, they did not show there. You add them back again. Then you deduct non-taxable income. So you see that the net profit will definitely increase. Somebody reported net profit of 5 million, and there is an expense of a disallowable expense of 2 million, for example. By the time you add that disallowable expense back, the total expense would have increased. So the non-taxable income, you deduct it. You deduct the non-taxable income. So there might be some income that are not subjected to tax that they have added. So you deduct it. Then the allowable expenses that they did not report, you equally deduct it. That's expenses that they were supposed to deduct that they did not deduct, you equally deduct it. Then you now arrive at what is called adjusted or accessible profits. Whether you are using adjusted or you are using accessible, is the same thing. It's just English. Then you will now bring in your loss brought forward. If for peradventure the previous year the company made a loss, and the loss was the loss is still in their book, and this year they now made profit, the company is expected to enjoy the loss relief. Loss relief is a topic on its own also. So the company is expected to enjoy that loss relief. So you bring out that loss and you deduct it from it. So then you now bring in what is called your balancing charge. You bring in what is called your balancing charge. Then you bring in your capital allowance. You bring in your capital allowance. Capital allowance is what the tax authority use in place of depreciation. Capital allowance is what the tax authority use in place of depreciation. So when you are adding back your disallowable expenses, you would have added back depreciation already. Because depreciation is a disallowable expense, so you'd have added it back to the profit. So by the time you get your you've added it back, you now come and less the capital allowance. Capital allowance brought forward, that if there is a capital allowance for last year that has not been relieved, you bring it forward. Then capital allowance for the year, if it's a business that's been running before, you have for last year, of course this year too will have its own. Then balancing allowance, you add it also. Excuse me. Then you will relieve for the year. You do your relief for the year. Capital allowance relief, you don't say, okay, because I have made a profit and I have capital allowance that is spending, you will not relieve all the money, use all the money to relieve capital allowance. No, there's restriction. It is restricted to 66 2/3 of the expenses of the profit. It is restricted to 66 2/3 of the profit. So you will not come and say, I made profit of 5 million and I have capital allowance of even more than, let's say, 10 million. And that's okay for this year. I will just take the 5 million profit that I made. It's not like that. It is restricted to 66 2/3 of the accessible profit. Then you now add income from trade and other sources. After you have released your capital allowance, you add income from trade and other sources. Then you now get your then you now have your income that you subject to tax. So at the end of the day, when you've gotten to that income, you will still bring in your tax table. I hope this is clear. Please, for those that have questions, let me give room for 2 questions. I will just call your name. Sorry, I didn't take note of your. Okay, we have just 2 people. Tokbe. Oluwafemi Tokbe. Tokbe, are you there? Please, if Tokbe is not there, let the other person. Mohammed, please ask your question. Can you hear me, please? Please confirm you can hear me.
Yes, we can hear you.
Yes, I can hear you. Can I ask you?
I can hear.
What's your name? Your hands were not. You didn't raise your hand before. My hand
was raised first. I'm the first person. I was even the one that interrupted you.
Shidima, right?
Yes.
Okay.
Chimamanda.
Oh, Shimamanda, sorry.
Okay. My question is, when you were explaining about earned income and unearned income, right?
Yes,
what if they employ me and I didn't tell them about my unearned income? Maybe some of the investments, some of the stock investments I made, and I didn't tell them about it. I mean, how would they know, right? And another one is, I don't this balancing charge and balancing allowance, like, what is it about? That's all.
Okay.
Thank you.
So first of all, let me answer the first question, that you did not tell them that you have investment. So there's what is called self-assessment. As an employee, your company is going to assess you and remit your tax for you at the end of the year. They will only assess and remit your tax for you to the extent that they know, to the amount, the extent of the amount that they know you are earning, which is most likely your salary. You are not expected to start telling them, I'm paying this, I'm getting this, I'm getting that. But you are expected as an individual to do your own self-assessment. That is where you add what your company has remitted for you to what the other monies that you earn outside your employment. You add it together and you go and present it to the tax authority. In cases where you are requiring, you are applying for things like TCC, your tax clearance certificate. Not as an individual, you apply for your own TCC too. Then you will know that there is place for your own self-assessment. So you don't necessarily need to tell them that you have an investment somewhere and they should add it to it. They are not even in the position to do that for you. So as an individual, you are expected to assess yourself. So you will add what your company has remitted for you together with what you are expected to remit, and you remit it. Ideally, on a monthly basis, if you have another income outside what your company is paying you, you are supposed to be remitting it. Yes, you are supposed to be remitting your tax based on that. That's why the portal is there for everybody to access. If you log into your portal, you see where what your company have remitted to you. You can still remit your own and add it up. So at the end of the day, everything will sum up together and count for you as your total tax remittance. So balancing allowance or balancing charge, they are adjustments that you make when there is a disposal of an asset. The adjustment that you make when it has to do with fixed assets. When you do company income tax, you get a better understanding of it because you see the practical application. There are adjustments that you make when there is a disposal of an asset that you have previously claimed capital allowance on. Something that you have claimed capital allowance on, you are not selling it. So what you are getting at that point is your balancing allowance. Then how do you know which is balancing allowance? When the tax written down value of that asset is less than its when the amount you sell is less than the tax written down value. So maybe the asset still has some useful life and there's a tax written down value of it. You now sold it less than that amount of that tax written down value. Then you have a what is called balancing allowance. Then when the tax written down value is higher, when the selling price is higher than the tax written down value, what you get is your balancing charge. I don't know if this is clear, if you get the understanding. So the adjustment that you make in respect to disposal of a fixed asset. The adjustment that you make in respect to disposal of a fixed asset. So when the asset that you are disposing is something that you have already you've been claiming capital allowance on, you have a tax written that value. It might not really be clear now because we are not doing capital allowance. We're not doing capital allowance here. They might not really be clear, but just get it that balancing charge and balancing allowance, they are adjustments that you make in respect to disposal of a fixed asset. So when you are disposing a fixed asset and you sell it below the current amount or the net book value, then it is a balancing allowance. Then when you sell it higher than the net book value, then it is a balancing charge. Let's continue. Okay, before we continue, let me hear from Shimamanda. Did I answer the question? Did you get the explanation?
Yes.
Okay, so that it doesn't look like I just imposed it on you. So by the time you take capital allowance, again, is a topic on its own. So by the time we treat capital allowance, you will see when we start attaching figures to it, you see the cost of the asset, the tax written down value of that asset, and now the asset was disposed at a particular amount. So you do the comparison, you compare the tax written down value to the selling price of the asset. Then you yourself, you will determine whether it is a balancing charge or it is a balancing allowance. So let's continue with our class. Our time is far gone. I wanted us to take a question today, but with what the time I'm seeing now. So let's quickly continue. Where there is no chargeable income for an individual, or we're looking at minimum tax. This is the second time we're treating minimum tax again. So when there is no chargeable income for an individual, or where the tax payable on the chargeable income of that individual is less than 1% of his total income, the individual shall be charged to tax at the rate of 1% of his total income. In essence, minimum tax is at the rate of 1% of total income. So when the person does not have any taxable income, maybe after you did all the deduction and the rest, before we get to taxable income, there are a lot of deduction, consolidated relief is there, tax exempt is there, on income that are no longer subject to tax, they are there. And at the end of the day, you see that what is remaining, there is no taxable income. What you do, you charge that person to minimum tax. So the minimum tax shall be payable where the taxpayer has no taxable income because of large personal relief. The person is not any minimum wage. Let's get it clear. You know, there are people that are exempted from tax, people that earns below minimum wage, they earn minimum wage and below. They are not the people we are talking about here. These are people that are in the tax net. But after deduction, we discover that what is remaining, there is no taxable income. Then we subject them to what is called minimum tax. And minimum tax is 1% of your tax income. Tax authority, they are not playing. They are not playing at all. So it's 1% of the tax income. So it happens where the taxpayer has no income because of large personal relief or taxable income produced tax payable lower than the minimum tax. What you are producing, well, at the end of the day, when they see your taxable income and they charge tax in it, what it is getting, what we are getting as a tax is lower than minimum tax. It's lower when we will use 1% directly on your total income. Then the tax authority say we should opt for minimum tax in that case. Section 36 of the Personal Income Tax 2004 as amended by the Finance Act 2020 states that minimum tax under this section or as provided under the 6th schedule of this act shall not apply to a person in a year of assessment where such person earns the national minimum wage or less from an employment. It seems I was even like, I already explained this. That minimum tax is not for people earning below minimum wage. Don't come and say because the person in your company, their money is small, so it's minimum tax. It's not minimum tax. So we have already stated the reason why we should use 1% when the person has no taxable income because of large deductions, large personal relief. Those relief are allowable relief. You need to do them, and at the end of the day, after doing it, you discover that there is no amount to charge the tax on. Then you go for minimum tax. Then when what you have as tax is small compared to when you will use minimum tax, then also you go for minimum tax. Filing of returns for employers not later than 31st day of January of each year. This is your annual return and not the monthly payee. This is annual return, not monthly payee. Monthly payee, we already ascertained the deadline as 10 days of the following month. But the annual return, so at the end of the year, there is what we call a consolidated payee. Me, I call it consolidated payee. So your employer, the accountant that is in charge of that thing, we bring everything together, all the payee that they have been deducting from your salary. They'll bring everything together in one Excel sheet according to the number of employees that they have, and they will file it to the tax authority. They are not paying, they have already paid. They will just file it to the tax authority to compare what they have paid before to what they were expected to pay. Now, if there is any difference, for maybe you pay lesser than what you expected to pay, you are expected to make up for the difference. And if you even pay higher, then the other part can be used as tax credits for the other subsequent payment. Not later than 31st day of January of each year, an employer is required to file a return with the tax authority of all emoluments paid to the employees in its employment in the preceding year. The return in respect of employees shall show the total emolument of each employee during the month, the tax relief, if any, and the total tax deducted from the employee. The return specified above shall be accompanied by a statement and a declaration on Form H1 or any other form approved by or prescribed by the relevant tax authority. Any employer who contravenes the above provision shall be liable on conviction to a penalty of 500,000 in case of a body corporate and 50,000 in case of an individual. Please, let's take note of all of these small penalties. They can come in your question AII. So if you did not do that 31st December remittance, filing, not remittance, it's just filing, like I explained earlier. as a company, the penalty is 500,000. Then as an individual, the penalty is 50,000 naira. So it is compulsory. You see, January, as from 24, 25, you see most of the accounting group, people will be reminding each other, hope you have filed your company's own, hope you have filed your company's own. Because definitely, in most cases, if you refuse to file it as the accountant that is in charge, some companies can push the penalty to you that is you that did not do your job. That's for that. Anyway, employees under section. Employees for each year of assessment, a taxable person shall, without notice or demand, file a return without notice or demand. You are not expected to be told, because ignorance is not an excuse. File a return of income in the prescribed form and containing the prescribed information with the tax authority of the state in which the taxable person is deemed to be resident, together with a true and correct statement in writing containing the amount of income from each source. So you that ask that, will I tell my company that I'm earning this? This is not what for you. Your company has done their own. If they don't do it, it's the company that will be held responsible. Now, as an individual, now you are expected to also do this. You are expected to file without notice. You don't expect somebody to come and tell you. So most times we Nigerians, we tend to wait for people to tell us, or when we need some things. Earlier this year, somebody in my organization needed tax clearance certificate for a personal use, and I was the one that did the processing for him. While we were on that tax clearance certificate process, we were meant to file his tax for that year, and it was already past the date, the due date. It was already past the due date. We had to make some payments. Thank God the person did not even have other source of income. According to him, he does not have other source of income, so it was just the one that company remitted for him. So, but we had to make some payments in the office before we were able to get that tax clearance. But that's something that he would have gotten on a like free if he had done the normal thing that he's supposed to do. So as an individual, you're expected to file your tax at the end of the year to the tax authority, stating the amount of income from every source. Such particulars as by the return may be required for the purpose of this act, and rules or regulation with respect to any such income, allowance, relief, declaration, deduction, or otherwise as may be material for that purpose. The form of return shall contain a declaration for which shall be by or on behalf of the taxable person that the return contains a true and correct statement of the income computed in accordance with the provision of the act or regulation. So let's quickly look at the relevant tax authority. The relevant tax authority, personal income tax, that covers personal income tax. So, as provided in section 2 of PITA, PITA is Personal Income Tax Act, the act that governs the personal income tax. That's PITA. Then CITA is Company Income Tax Act. The relevant tax authority may vary from person to person. So for individual, corporate, sole, or body of individual, the relevant tax authority is the state where the individual is deemed to be resident for the assessment year. Taxes are expected to be paid to the relevant state internal revenue. So this tax authority, how do we know where to pay each tax to? For an individual or a body sole, like a sole proprietor, somebody that owns a business. We know the different types of business. Or body of individuals. But by body of individuals now, so we can call them what's it called? Partnership. So their tax is to be remitted to the state where the individual is deemed to be resident for that particular year of assessment. The relevant tax authority for the following other person is Federal Inland Revenue Service. For people that work in Nigerian Army, Nigerian Navy, Nigerian Air Force, and the Nigeria Police Force, and other and that are not in the civilian capacity, we remit their tax to federal inland revenue, like FIRS. That's where their taxes go to straight. Because come to think of it, army that does not stay in one place, how do you even determine the place of residence? So it's just better they are going to, irrespective of where they are in a particular year of assessment, their payment is going to the federal inland revenue service. But every other individual, their payment is going to the state which they reside within the year of assessment. Then for every resident of the Federal Capital Territory, Abuja, their taxes is going to FCT Internal Revenue Service. For those that reside in Abuja, Abuja has their own internal revenue service, so that's where their taxes are remitted to. Therefore, trustee of any settlement or trust or estate, or to an executor of any estate of a deceased person. So somebody that died, the person that they hand over the property to, the person that is sharing it, that is executing those property, the relevant tax authority is the state in relation to such settlement, trust, or estate is first administered, or in which the deceased was last deemed to be resident. So we can look at where the person that died was, what was his last residence. That place will be where the taxes will be remitted to. Therefore, communities, tax may be collected by the law of the territory, state, which is also the state in which that community is to be found. If you are paying the tax as a community, the taxes will be paid to the territory, which is also the state where that community is found. There are some places that they don't pay tax individually, they pay as a community, they pay as a group. Even their utility bill. I remember growing up, there was a time we were paying a utility bill as a group where I was residing. Once you need the utility bill, you meet the chairman or the secretary, they give you the bill. You don't have the individual bill. So for communities, they pay their tax to the law of the territory where the community is found. Then for families, income of families recognized under any law or custom in Nigeria as family income, in which several interests of individual members of the family are indeterminate or certain, the relevant tax authority is the state in which the member of that family who customarily receive the income in the first instance in Nigeria usually resides. So when it is a community type of income, family type of income, money that came into family, the person that first received that money, the state where that person resides is the state where the money will be, where the tax will be remitted to. That is when the tax is being remitted as a family tax. But if it's money that you are sharing to individual, the individual should pay their tax. But then for the itinerant worker, which we've talked about while we were doing employment income, taxation of employment income, the relevant tax authority is the state in which the itinerant worker is found during the year. Then lastly, we have the offenses and penalty for failure to deduct tax. Before we look at that, let me hear from you if we are still together. Let me see your emojis. Okay, thank you. Olamide Adediji. You have a question. Please unmute and ask your question.
Hi, good evening. Can you hear me?
I can hear you. Good evening.
Hello, can you hear me?
Yes, I can hear you. Good evening.
Okay. I just want to clarify something. The NHF, is it a compulsory deduction from employer? Is it compulsory that your employer deducts? That's what the NHF.
I've explained that before, that is compulsory. It's a compulsory deduction by the law. The housing fund, right? Is it
yes,
the
NHF.
National Housing Fund?
Yes,
it is compulsory. Yes. It is compulsory. Just that most employers, they don't really deduct all the relevant deductions. And even if they want to deduct all of them, we employee will still complain that it is too much. Forgetting that thing they are deducting is for our own good. They are contributing to have a house. So most of these things are practicable in the public sectors only. Most of them are practicable in the public sector only, but it is a compulsory deduction according to the law. I hope that answers your question.
Yes, it
Don't
does.
fight your
Thank
employer
you.
to come and deduct this thing for people. So you have your way of
Okay.
putting it in if you want to bring it in.
Okay, no problem.
Yeah. So there's a way you bring you bring those kind of things in. Do we have any other question? Muhammad,
Yes, I have a question, ma.
I've called you before. You were not here. You just
I
raised
was
your hand and you went to sleep.
my network.
Oh,
I
sorry.
spoke, you didn't hear me.
Oh,
So
I'm sorry.
regarding this allowable expenses and non-allowable expenses, I'm trying to understand it, but I'm finding it difficult to understand. Is it that by the tax law that is making it non-taxable? That is why they call it non-allowable. Or I want to get it in a layman so that I'll digest. Thank you, ma.
Okay. Please confirm you can hear me.
I can hear you. I can hear you.
Okay. So let's go to the layman as you have demanded. You've requested. Allowable, whatever we are doing tax-wise, it has to do with law. It's not what I think or what I feel. It's what the law says. That's what you abide with. That's why there is penalty for not abiding by the law. And there is no excuse that I did not know. If they release a tax refund or they release a new tax law, all of us are expected to go and read. I quarreled with somebody that was saying rubbish concerning this new tax refund in one of the group. You are expected to read and digest it, understand it, ask questions where you don't understand, so that you can apply it. Because if refusing to apply it is another issue. So now let's go to the allowable and non-allowable expenses. The tax law has specified things that are allowable and also things that are not allowable. So it is the law that said it. So we have to follow the law. So what you need to do is to know what did the law say about this particular expenses. Did he say we should allow it? Did he say we should deduct it for the purpose of tax or not? Then that will help you. So whenever you have a transaction, whenever you have a particular expense, you should look at it and say, what does the law say about these expenses? You have to understand allowable and disallowable expenses. So because throughout this tax journey to professional, it is there. It's standing there. So you have to understand it very well. So you have to pick, when you pick the transaction, you look at it and say, what does the law say about this transaction? And also looking at it generally as a business person or somebody that is business inclined, you should know what you need to do for you to be able to make profit. For example, salary. You employ people. You cannot do the work alone. You employ people and you pay them salary. That alone should be something that you know that without these people I cannot make this profit. So it's an allowable expenses. So to round it up, it is the law that said it. So what you need to know is to understand which of them is allowable and which of them is not allowable. I hope this helps.
Okay. Yes, thank you, ma.
You're welcome. Other face, Susan. Other face, Susan, please. Let's hear your question.
Good evening, ma.
Good evening. Please go ahead.
Please, can you throw more light on the basis of assessment?
Okay, let's go back to that. So basis of assessment.
Yes.
So like on the basis of assessment, I mentioned that the basis of assessment used by the relevant tax authority for determining personal income tax or determination of personal income tax for an individual should be actual year basis. Actual is like now, as it is happening, you are administering it, you are making the payment. Then preceding, when they say something is preceding, it's happening after. Preceding is like an after, something that has happened that had happened yesterday. The effect is not what we are working on after, but the actual is now. So, for example, taking payee, for example, payee, the salary is deducted, the tax is deducted as the salary is being paid. As a matter of fact, they will deduct it first before they will pay you your salary. Your salary is net of that tax. That makes it actual year. While preceding, it's something that will happen later. For example, those are our unearned income, like dividend. Company cannot pay dividends in that current year. They'll pay the dividends in the year after. So you see that the dividend that you earn for year 2024, for example, if you invested with a company now, for example, and the company pays you dividends on a yearly basis, there is no way they will pay you dividends in that within the year. They'll pay you the dividends after the year, and you are paying the tax as the dividend is coming. So that is why it is preceding. That tax is not a tax for a dividend of year 2024, and the tax is being paid in year 2025. That tax is not a tax of 2025. It's a tax of 2024, but it's paid in 2025. That's why it is preceding. I hope this answer your question.
Yes, ma. Thank you, ma.
Okay. So in the absence of no other questions, so let's quickly continue so we can round up the theory aspects today. I was expecting that we'll take a practical question.
Sorry, ma'am.
Practical questions. Is that a question also?
Yes, ma'am. About about the allowable expenses. That allowable expenses can be used to reduce our profits, right?
Yes.
Okay, thank you.
The allowable expenses are the expenses you deduct before you get to your profit. So the point here is that if you put the expense that is not allowed, the tax authority will add it back. Then the profit that you have declared, the 2 million that you have declared, will now increase because something that you deducted to get that 2 million has been added back again. So let's quickly look at the penalty. In our next class, we'll take 1 or 2 calculations before we go to the next topic. Even though I was hoping that we can take that calculation today. So we have the penalties for not remitting tax. What are the penalties for not remitting your payee? Offenses and penalty. This is clearly stated in section 74 of the Personal Income Tax Act in 2004. Any person, body, corporate, who being obligated to deduct tax under the section 69, 70, 71, or 72 of Peter 2004 as amended by the Personal Income Tax Act fails to deduct or having deduct and fails to remit. Some employers are very good at this. They will deduct it, but they will not remit it. So having deducted and failed to remit such to the relevant tax authority within 30 days from the date the amount was deducted or the time the duty to deduct arose, shall be liable to a penalty of an amount of 10% of the tax not deducted nor remitted, plus interest at the prevailing monetary policy of the Central Bank of Nigeria. So if you deduct and you did not remit, or you did not even deduct at all, you are going to pay 10%. The penalty is 10% plus the interest. The interest now will be on the prevailing monetary policy. That's the normal interest rate as at that time, and you know it varies. It can be 20%, it can be 10%, it can be 50%, depending on the time. So you are going to pay that interest on the said amount that you did not remit. So 10% is fixed. Why 10% is fixed? The interest is not fixed. The interest will be determined by the prevailing monetary policy of Central Bank of Nigeria. Employers to be answerable to tax deducted in line with the section 82 of Personal Income Tax Act 2004 is employer that they will call. So if you have a company and you are not deducting tax, or you are working in a company that the company is not deducting tax, is the employer that they will call. In the event of failure by the employer to make the deduction or properly to account, therefore, the amount therefore, together with a penalty of 10% per annum of the amount plus interest at the prevailing commercial rate shall be recoverable as a debt due by the employer to the tax authority. So by the time the employer refused to deduct, and maybe 1 year had passed, 2 years had passed, every year that you refuse to deduct, they will be calculating that 10% for you per annum every year. They'll calculate the 10% for the employer, plus the prevailing interest rate, plus another interest, percentage, which will be determined by the interest rate as at that time. All of this will be calculated as a debt. The tax authority, they are very funny. They can just do their calculation and even send you. You'll be like, where did these people get this figure from? So they are very funny people, but they are doing their job and they are actually administering the law. So as an employer, you are expected to deduct the taxes that are due from your employers. They are paying them salary. There's no stress. The problem is that most employers don't want to employ the right skilled people to do the job for them. They want to employ somebody that cannot even do the work in the first instance. So you're expected to deduct salaries, deduct the taxes from before you even pay salaries. And these taxes will be remitted to the authority. It is one thing to deduct, like I explained. It is another thing to remit it. Don't deduct and use it for your business. It's not your money. It's government money. So if you refuse to deduct, the tax authority will calculate it and they will send you the as a debt that you are owing them this amount. You should go and pay. So these are the penalties. So what you should be looking out here is the percentage, 10%, and the prevailing interest rate. That's what will give to you. So if you are given a question to calculate penalty, of course, they will give you the interest rate for that question. They'll give you the interest rate. But you know that the 10% is always a fixed amount. So that will be the end of our class. That's where we'll stop today. We are supposed to take questions, but I don't want to exceed 9 because that class by 9. Please confirm we are still together, and if you have any question, you can raise your hand. Let me see your hand, so we can use the next 4 minutes to answer the ones that we can answer. Then every other one you can drop it on the group. Shima Amanda.
Okay, thank you very much. The 10% we are paying for the penalty, is it 10% of the tax, of the supposed tax, or
yes,
the 10%?
Yes. Or what? Let me get your perspective.
Is it 10% of the supposed tax or 10% of whatever the state internal revenue calculated from themselves, like the figure they will get from themselves?
Okay, it's 10% of the supposed tax, but by then you and them will now have to align on what the supposed tax is, because they will calculate and bring for you. Will you accept it?
No.
That's the question. You will not want to accept it. You want to tell them, no, what you people calculated is not it. Then you will not bring what it is, and you guys will align. So by the time you align, the 10% will not be levied on it, and the interest rate also will be levied on it. So the best is even to just remit it.
Okay.
Remit when you are supposed to remit. So avoid those things. They distract business. They distort business. By the time tax authorities are coming to your business premises, is a different, like it will disturb your operations. Azan. Azan Quadri.
Yeah, good evening.
Good evening.
Yeah, thank you so much for the class. We really enjoyed your class. May God continue to increase in knowledge and understanding.
Amen.
Yeah, in brief, my question is for the what's it called? The contract staff. You know, we are going to pay withholding tax on them.
Yes.
For the contract staff of the company. Yeah, like the security, like our company now, we outsource our security staffs. So the particular security outsourcing of that we usually pay all the security money. So they are going to now disburse it to each of the securities. So I also ask that what was the percentage for the withholding tax on that? And also I also ask that the 10% that you just made mention now, is it also applicable to delay or non-remittance of such tax
Okay.
to such outsourcing firm?
Okay. So this is a withholding tax question, not necessarily a pay question. So for an outsourcing company, for contract staff that you outsource through a company, it is the company that will deduct and remit their pay, not you. What you will deduct is the withholding tax on the maybe the service charge, depending on how the invoice is placed. The service charge, the contract staff, let's say you have 5 security and each of the security are 50,000. You are paying 50,000 for each of the security and the company is charging you maybe 10%. That's 20,000. You charge your withholding tax on that service charge of the 20,000. It is that withholding tax that you will remit on behalf of the company. You do not have anything to do with their pay. It is that company the outsourced company that will remit their pay. Then the 10% we are talking about here is for not remitting pay, not for not remitting withholding tax. Not remitting withholding tax has its own penalty. So when you do withholding tax, you will learn about the penalty that is associated with not remitting withholding tax. I think you guys have done that of VAT, and you've seen the penalty for not paying VAT. 50,000 for the month you did not pay, and 25,000 for the subsequent month that you refuse to pay. So that's for VAT. So withholding tax as a type of transaction tax has its own penalty. I hope this answers your question. Quadri, are we
Yes,
together?
ma'am. Thank you very much.
You're welcome.
Yes, ma'am. Thank you very much.
Okay. Which of the names should I call now? Do we still have any hands up? Quadri, please lower your hand. Let's see. Ayiba, Sari, Lavender.
Yes, ma. Thank you, ma. So my question is, is there a tax audit done on payee tax?
Okay. So this will be the last question. Yes. Tax authority, you cannot determine where they want to come for tax. So that's why you need to keep your cupboard clean. You need to keep your books clean. They can come for a tax audit anytime, whether on payee, whether on transaction tax, whether in any type of tax.
So I thought there's a period, like for our company where we work, they recently did a tax audit for our company.
Please, let's take this question to the WhatsApp. Our time is up. There's another class now. So let's not eat into the other people's time. You can send this question to your group. Thank you for your time and see you next week.
Thank you.
Good night.
Good
Yeah,
night.
bye. Good night.
Please, can we get the notes, please?
And please share us your notes, ma.
I will share it. I will share it.
Thank you, ma. Thank you.
All right, thank you.